Canada's annual inflation rate has once again risen, climbing to 4% in August. The jump follows a 3.3% increase in July. StatsCan says the increase is largely driven by the price of gasoline. In addition to higher energy prices, Canadians also paid more for rent and mortgage interests in August. And while the cost of groceries is still high, the price of food rose by 6.9% in August, a little bit lower than in July. With me now is David McDonald, senior economist at the Canadian Centre for Policy Alternatives. David, good morning. Nice to see you again. So we're saying in line with expectations, but was it higher or lower, do you think, than what you were expecting?
Well, it was definitely higher. This is certainly bad news in terms of setting us up for more interest rate hikes in the fall and winter. There's a broad expectation of about 3.8. We're now at 4% broad inflation. The other thing, too, is that the Bank of Canada has its own specialized CPI measures that it follows more closely than the headline number. 2 out of the 3 of those increased this month. They have been consistently well outside of the 1 to 3% range, and that situation got slightly worse this month. So definitely not a good report, and certainly not setting us up, is certainly likely setting us up rather for interest rate hikes to come.
But is the counter argument, well, we knew it was going to take a while for the previous hikes to work their way through the system, we just need to be patient?
Well, what's interesting at this point is that interest rate hikes will affect certain parts of the CPI index, but not others. One of the big drivers this month is actually gasoline prices, where you wouldn't really expect any particular impact from interest rate hikes because we don't buy gasoline with debt. In some of the other areas where you would expect a bigger hit, in things like housing, for instance, where you'd expect a drop in house prices, we're actually seeing house prices relatively flat, so no big impact on house prices, nor a big impact on real estate transaction costs, which is another area where you'd hope to see anyway a decline due to higher interest rates. Unfortunately, higher interest rates now are driving key parts of the inflation index. This is particularly true on rent. Rent up 6.5% year over year. This is the highest rent increase that we've seen in at least 30 years since the start of the 1990s. So just a real big impact on the rent side. And as well, a continued impact on mortgage interest. So anybody who has to renew a mortgage or has a variable rate mortgage knows very much that higher interest rates drive their mortgage costs. These are 2 areas that are being driven up by higher interest rates, unfortunately. And so we're in this dangerous situation where we are not within this 1 to 3% range. We're above it. Key parts of the index are going the wrong way insofar as interest rates are driving those parts of the inflation rate further up. And so, if we saw another report like this in mid-October, just prior to the October 25th Bank of Canada decision, I'd be concerned that we might be looking at another increase in interest rates in either the October or the December decision of the bank.
Well, I think that leaves a lot of people confused. Because if higher interest rates are driving inflation, doesn't that mean that this is self-inflicted? Can you clarify that? I don't get it.
Well, that's right. Part of it is. I mean, the theory here, of course, is that if interest rates go high enough, you get higher unemployment, you get less spending in the economy, and as a result of that, you see lower inflation. Certainly, we're seeing lower inflation in some discretionary spending in this report, particularly with respect to tourism. So airline tickets are getting cheaper, for instance, or tours are getting cheaper, for instance. And I don't think there's any doubt that if interest rates got high enough, you cause a recession. And a recession will probably have the result of decreasing the inflation rate. Of course, the Bank of Canada is targeting the inflation rate. That's what they're interested in. The labor market, the general economy are of secondary concern to them. Their primary goal, and this is the direction that was received from the government of Canada, was get this inflation rate back down to 1 or 3%, come hell or high water. And they're probably going to do that. And so if the interest rate is high enough, we will likely see, much bigger impact, say, in the housing markets and declines in housing prices that may offset the increase in mortgage interest costs. We haven't seen that so far, but it's certainly possible. And so that's the real danger, is that we're not getting to where we need to be even at a 5% interest rate. We might get there at 7%, but we might not like the consequences in other areas of the economy.
Final thought from you, please. Can you give us some analysis on food prices? We saw them drop a little bit. This, of course, coming the day after all of the grocery CEOs were meeting with ministers in Ottawa to do something to control the rising cost of food. Was there a little bit of good news here for Canadians? Should we see this perhaps as something that was seasonal because we're able to buy more things at local farm markets during this time of year? What are your thoughts around the price of food just going down a little bit?
Absolutely. So if we take a look at the food prices on a year over year basis that we would buy in grocery stores, for instance, they are down still. They're up 6.5% from last year in August, but the July figure was higher than that. Usually looking on a year over year basis, but if we look just on a month over month basis, how much did prices change between July and August? They actually fell slightly, 0.4%. Now, these figures are seasonally adjusted. If we look over the year to year amounts, they are seasonally adjusted. So you're comparing to the same time period last year in August, when again you would have been able to have more variety, for instance, in terms of what you could buy in local produce. The big increases in prices when we look on a year over year basis were really in November, December, and January of 2023. When we look on the year over year basis, we're still including that in the year over year amounts. But if we look on the month to month, there really haven't been tremendous increases over the last couple months. And so certainly there, over the course of the summer, we have seen some moderation, in fact, some falls in food prices if we just look at the summer of 2023.
David McDonald is a senior economist at the Canadian Centre for Policy Alternatives. David, thank you so much. Appreciate you being with us this morning.